Hi there, I'm Edward Kalstien, founder of EKH Capital, where we look for market-beating stocks for the long run. Today, we're diving into Visa, a leader in the global payment space. We're going to break down Visa's stock using the 5 key factors to determine whether it's undervalued, fair valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. Don't forget to like and subscribe. Now let's get into it. First up, we want companies that know how to deploy capital efficiently, ideally with a return on invested capital and return on equity ratio that is above 15%. Visa delivers here in a big way. Return on invested capital at 25.4% and return on equity at 50.7%. Over the past decade, both metrics have trended upward. Aside from the dip in 2020 during COVID, these are elite level returns that speak to Visa's operational efficiency. Next up, growth. And Visa has definitely been on the move. Over the last decade, revenue grew at a compounded annual growth rate of 11.1%. Net income grew at a compounded annual growth rate of 13.5%. And earnings per share grew very strong with a 15.9% compounded annual growth rate, ending fiscal year 2024 with $9.7 in earnings per share. Visa is well positioned for continued growth, holding a dominant market share of around 40% in the global payments industry. As digital payments grow, driven by trends like e-commerce and mobile wallets, Visa stands to benefit, especially in emerging markets. With the global payments market expected to grow at a rate of 5% annually through 2028, Visa is poised to capitalize on the shift from cash to digital. Its strong brand, extensive network, and focus on innovation, such as blockchain and AI, further enhance its long-term growth potential. Now let's talk about Visa's financial health. Visa currently holds $15.2 billion in cash and short-term investments, but has $21.8 billion in total debt. So they can't fully cover their liabilities with cash alone. But how healthy is their leverage? Well, it looks pretty solid. Over the last 9 years, their debt-to-equity ratio has stayed pretty stable, ranging from 0.5 to 0.7. For the alert ones out there, back in 2015 it was 0, since Visa didn't have any debt at all. This shows that Visa keeps its debt in check and has plenty of room to invest in future growth, without taking on too much financial risk. Let's talk about Visa's valuation. Right now, Visa is trading at a price-to-earnings ratio of 32.7, which is higher than the S&P 500's PE ratio of 26.2. But here's the thing. Visa's earnings per share have grown at 15.9% annually over the last decade, nearly double the S&P 500's 8.9% annual earnings growth. Now, according to legendary investor Peter Lynch, a company might be undervalued if its earnings growth rate is higher than its price-to-earnings ratio. Visa doesn't quite check that box right now, but that's not surprising. High-quality, resilient companies like Visa rarely go on sale. Historically, Visa has traded at premium valuations due to its duopoly position with MasterCard. But with ongoing market volatility and trade tensions, Visa is a stock worth keeping on your radar. If Visa's PE ratio ever dips closer to 25, that could provide a more attractive valuation. Visa has a strong moat, built on its global payments network, massive brand recognition, and strong relationships with financial institutions. Its network processes over 200 billion transactions annually across more than 200 countries, making it nearly irreplaceable in the digital payment space. The scale and trust Visa has developed give it a significant cost and data advantage, while regulatory licenses and security infrastructure raise the barrier for new entrants. While Visa benefits from mobile wallets like Apple Pay today, since they drive more digital transactions through its network, there is a potential long-term risk. If tech giants or fintech companies develop closed-loop systems that bypass traditional card networks, that could eat into Visa's dominance. Additionally, Visa doesn't issue cards or lend money, so it's heavily reliant on transaction volume, making it vulnerable during economic downturns. It also faces regulatory scrutiny, particularly around interchange fees, which are small charges that merchants pay to the customer's bank every time a credit or debit card is used for a purchase. So while Visa's moat is strong, staying competitive will depend on how well it adapts to the fast evolving digital payments landscape. Now, before we conclude on Visa, you may have spotted in the chart shown in my video that these were created with the help of Fintech. If you would like to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for Fintech and unlock powerful tools to make smarter investment decisions. In my view, Visa stock is fair valued based on the 5 key factors. Visa delivers solid returns on capital with a 25.4% return on invested capital ratio and 50.7% return on equity, showing strong financial efficiency. Earnings per share grew 15.9% annually over the last decade, which is solid growth. Debt is well managed with a low debt-to-equity ratio of 0.6, giving Visa the flexibility to invest and expand. With a price-to-earnings ratio of 32.7, it's not cheap, but with ongoing trade tensions, it's one to watch. At a lower PE ratio of around 25, it could offer better value. Visa's global payment network is a major strength, but its future depends on adapting to the fast-changing digital payments world. So what do you think? Is Visa a hidden gem or priced for perfection? Drop a comment below, and if there's a stock you'd like me to cover next, let me know. Thanks for watching, and I'll see you in the next one.